Welcome to Talk Tickers. You know, every so often you get an earnings report that just makes you scratch your head. And that's exactly what we've got today with Greenbrier. On the surface, their Q1 numbers looked absolutely fantastic, a real home run. But the way the market reacted, well, that tells a very, very different story. So let's dig in. All right, first up, the number that had everyone talking. Greenbrier posted GAAP earnings per share of $1.14. Now, the Wall Street consensus was sitting at just 84 cents. That is a massive beat of nearly 36%. I mean, they didn't just beat expectations, they completely blew them out of the water. But, and this is the big but, here's the twist. In the after-hours session, despite that monster earnings number, the stock actually traded down over 1%. Normally, a beat like that sends a stock soaring. Not this time, though. So, what gives? And that really brings us to the core question we're going to tackle in this explainer. You have a huge beat on earnings, a huge beat on revenue, so why the disconnect? Why on earth would investors see that news and decide to sell? Let's break it down. Okay, first things first. Before we get into the drama, let's just establish exactly how good these headline numbers were. Because believe me, the strength goes way beyond just that big EPS figure. So check this out. We already talked about the earnings beat, but look at that revenue line. They brought in over $706 million when the street was only looking for about $641 million. That's a double-digit beat on the top line, too. I mean, by any normal yardstick you want to use, this was just an absolutely exceptional quarter. And it just keeps getting better. The good news didn't stop there. Their aggregate gross margin was a really healthy 15%. They generated $76 million in cash from operations. And this one's a big one. It shows you just how healthy their leasing business is. Their lease fleet utilization was almost 98%. That's basically a no vacancy sign, right? It signals crazy strong demand. So with all this great news, we have to look deeper into what management was actually saying. And when you dig into the commentary, what you find is a classic tale of two speeds. The overall numbers look fantastic, sure, but when you look under the hood, there's a pretty clear split in how different parts of the world are performing. And here it is. This is the heart of the problem. North America, it's firing on all cylinders. You've got strong demand, that super high utilization we just talked about, and orders are picking up. It's the engine of the company right now. But Europe, that's a whole other story. Management got pretty candid about what they called operating inefficiencies and said they're in the middle of restructuring and right-sizing the business over there. This is the anchor that's dragging on the whole story, and it's what has investors spooked. Now, CEO Lori Tekorius tried to frame this as a strength of their overall business model. The idea is that because they have both manufacturing and leasing, the business is more resilient. It can produce what she called higher lows during the down parts of the cycle. Basically, they believe the model is working just like it's supposed to, even with all the headaches in Europe. And this is the crucial point. Despite all the weakness in Europe, management came out and reaffirmed their full-year guidance. They didn't blink. They didn't back down. That signals to you that they believe these problems are manageable and that they're banking on a much stronger second half of the year to hit their numbers. But, for the market, talk is cheap. Which brings us right to the investor mindset. The market heard the guidance, yeah, but its reaction tells you everything you need to know. We've moved from a show-me story to a prove-it story. Right now, investors have their eyes on three very specific things. First, they need to see that railcar deliveries are actually on a path to hit that full-year guide. Second, and this is the big one, they need to see real, tangible proof that the turnaround in Europe is actually working and that margins are getting better. And third, they just need to make sure that the North American engine stays humming along. Until those boxes are checked, the stock is probably going to have a tough time. Okay, so let's put it all together. How should we be thinking about Greenbrier as we head into their next earnings call? Well, here's our take. So we're expecting the next quarter's results to look, well, a lot like this one. Turning around a major operation like their European business isn't something that happens overnight. It's going to take time. And because of that, we see the stock pretty much staying range-bound, kind of treading water. The market is going to wait for cold, hard proof of margin expansion from that European fix before it's willing to push the stock higher. And for all those reasons, we are initiating our coverage with a market perform rating. The downside feels pretty limited here, but the upside is definitely capped until that whole European story gets a lot clearer. Now, given that kind of stuck in the middle feeling, let's explore an outrageous but plausible trade idea that actually looks to take advantage of this exact situation. The thesis here is actually pretty simple. You've got a strong North American business, a nice dividend, and they're buying back stock. All of that creates a nice floor into the share price. At the same time, the uncertainty in Europe is creating a ceiling. That makes it a perfect setup for selling cash-secured puts. The goal here is twofold, really. First, you collect a premium. You get paid just for being willing to buy the stock at a lower price. If the stock stays above your price, you just keep that cash. Simple. But second, if the stock does drop, you get to buy the shares at that lower price you already wanted, so you're basically getting paid to wait for a discount on a solid company.
And that is our full breakdown of Greenbrier's tricky quarter. Thanks for tuning in to Talk Tickers. And as always, a reminder, this is not financial advice.